welcome back to Cambridge House Live. I'm Vanessa Collette here at the Vancouver Resource Investment Conference, and we're being joined by Rick Rule, the chairman of U.S. Global Holdings. It's great to see you again, Rick.
Always a pleasure, Vanessa. Thank you for having me.
Now, Rick, last year the sentiment at the show, in my opinion, really was a cautious optimism. Are we still in that kind of phase, or have we come a little bit further from there?
With the caveat that Vancouver is a very emotional audience. The last 2 or 3 weeks have given people here cause for hope, and they've taken it. So I would suggest that the mood here is much more than cautious optimism. I think that mood is a very thin veneer, and if the gold market turned down, you'd see a replay of last January in terms of outlook very quickly.
Right. Now, you were telling me just before we got started, you barely had holidays, things have been so busy at your office. So what are some of the indicators that are really making you, seize the opportunities right now?
At Sprott, we've worked very hard through the downturn to position ourselves for the recovery. So unlike many of our competitors, we're still cash rich. We also have the ability, even in a bad market, to raise money because we've been in business so long and have a deep established clientele. It's incumbent on a firm like ours that's determinedly contrarian and resource focused that we take advantage of a bear market, which, as we discussed last year, is a different word for a sale, to take advantage. We discussed before the interview the fact that most participants' expectation of the future is set by their experience in the immediate past.
Right.
So in bull markets they're too aggressive, and in bear markets they're too cautious. And at Sprott we're trying very hard not to be too cautious.
That must be challenging. I think we were also saying a lot of people, when things are good, they have a hard time seeing them being any different, and when things are bad, they also have a hard time seeing when the good times will come again. Do you think North American culture is a little bit more short-term thinking in the thinking?
I'm not so sure of that. I suspect that we're exposed, not just in North America, but your generation in particular, to much more stimulation. And I think one of the things that happens is perhaps there's a lot of information, but perhaps wisdom is in the same supply it has always been in. So you have more stimulation, but it still goes to people's precepts and prejudices.
Right, but to be a contrarian, you really have to be a long-term thinker.
You absolutely have to be a long-term thinker. And to be in the resource business, you have to be a long-term thinker. It is a particularly cyclical, particularly contrarian activity, which is difficult for most people.
So what are you doing with your investments right now, Rick?
Very much what we've been doing all the way along. We have found for the last 3 years that the opportunities available to us as lenders have exceeded the opportunities available to us in the equities markets. So while the travails of the resource equity markets have been well documented, we've generated a 16% annualized internal rate of return at Sprott Inc. in our lending activities. So certainly we're doing that. One of the things that's changed very recently is that we have the ability to expand our presence in Calgary, which is suddenly capital short after many years of having too much capital in place. So we're seeking to expand our development drilling activities in Calgary as the industry pulls in its horns. And we're certainly looking to increase our energy lending activities while our competitors are licking their wounds.
So you're speaking mostly of oil. Is that something that you guys are looking at now because the oil prices had such a steep decline?
Whatever the world hates, we try and like. The truth is, in the natural resource business, if you're not a contrarian, you're going to be a victim. What I've learned in resources is because it's so capital intensive that you need to have the courage to buy industries that are literally in liquidation. Industries where the selling price of the commodity is less than the production cost. Because when that happens, either the price of the commodity goes up or the commodity becomes unavailable. So while it's very difficult to do, commodities that have been in catastrophic market conditions are the ones that always offer the best opportunities.
Right. I think, as you've always said, there's no cure for low prices like low prices. Right?
Exactly.
So how much of your money is invested right now?
At Sprott Inc., we are reasonably close to fully invested, except that much of it's invested in short-term loans, so it turns over.
Okay.
We have also been fairly active in the development drilling business, and so the cash that we generate from that activity, even at low oil prices, is pretty high. In terms of the money that we invest for clients, or in conjunction with clients, we have a lot of cash, a lot of dry powder.
And are you yourself fully invested in the market?
I am not. I have not been as fortunate, I guess. I have very large cash holdings, and I am seeking to be much more fully invested.
So are you waiting for a certain event, or are you waiting for a big cyclical washout?
In my own personal portfolio, which I think is where the question is going, I am fairly well represented now in bullion, platinum and palladium, gold and silver, and I'm in pretty good shape in the investment part of my portfolio. In the speculative part of my portfolio, for 30 years, I have been an active private placement investor. And I would be fully invested except for the stubbornness and the stupidity of the issuers who refuse to do financing transactions at prices that reflect the market conditions that we're going through.
That's the one thing that's holding you back right now?
When the opportunity presents itself, Vanessa, believe me, I will be an aggressive check writer. I believe I can go longer without writing checks than they can go without cashing checks.
What do you think the average investor should be doing right now?
Buy the best of the best. Most investors make the mistake of assuming that gold stocks will outperform gold. The truth is, if you think the gold is going to go up, buy the gold first. Many of the companies that purport to be gold companies don't have any gold. And if the price of something that you don't have any of goes up, it shouldn't really matter to you. When you move from the gold to the gold stocks, buy the best. There are 39 large producers and intermediate producers worldwide, 7 or 8% of which generate all of the positive performance. Don't buy the index, buy the 7 or 8 best. That's the thinking behind the Sprott Gold Miners Trust. Don't buy market cap weighted, buy performance weighted. And when you move down into the juniors, and do move down to the juniors, remember that sometimes a $5 stock is cheaper than a 5-cent stock. Buy great people, buy great optionality, buy great deposits, buy with the view of answering an unanswered question, buy with the view of a catalyst.
Now, a lot of money in the sector has flown into tech. Have you guys looked at tech companies, or what do you think it'll take to bring that money back into mining?
I don't know that it will come back into mining. I live in California. I live in the tech world.
Right.
And I know some very, very, very good tech investors. We have a director on the Sprott board, Paul Stevens, who was the Stevens of Robertson Stevens. He's a resource investor and he's a tech investor. I'm not a tech investor because I understand resources. I'm exposed to opportunities in California that I can't pronounce. And the idea that I'm going to be involved in a business that'll be obsolete in 24 months, in other words, by the time I can spell it, it'll be obsolete, relative to being involved in coal or uranium or water, businesses that I've been involved in for 35 years,
right,
it makes no sense for this little boy to get out of his sandbox.
Well, being a contrarian, if you see a market, people are not in agreement whether it's a bubble or not, but you see tech stocks getting these extremely high valuations, that makes you think this must be a top, so that makes you stay away?
I'm not smart enough to give you the answer. I am smart enough to engage in activities where I feel personally I have a durable competitive advantage. I don't believe that I have that in tech. And by the way, I don't think that 90% of the investors that invest in tech have that either. And I think in that sense, they are going to have the same surprise that people who invested in resources in the last decade and knew nothing about resources got.
Right. Now, what are some of the indicators that are making you so bullish right now?
2, the gold price, first of all. People give you many, many, many reasons why the gold market reacts the way it does. I think it's much simpler. I think gold is in a war with the US dollar, and gold has been losing. Most people in the world would like to think that the big thinkers of the world stick-handled them through the 2008 financial crisis. Everything is under control, and the dollar represents good value relative to other currencies. I don't believe that to be the case. But I also don't think that gold needs to win the war against the dollar. It needs to just lose less badly.
Right.
And I think arithmetically, that's inevitable. The US 10-year Treasury, which is the world bellwether security, yields 1.6%. The US official inflation rate exceeds that. So the US government absolutely positively guarantees to give you back less than you give them over 10 years.
Right.
Jim Grant calls that return-free risk. The gold market is competing against return-free risk. It may not win this year, but it's gonna win. That's the first thing. The second thing, with regards to what your customers are really interested in, which is the TSX venture market, I know who your customer is.
Right.
This is a market that's down by 83% in nominal terms and 90% in real terms, which means, again, let's look just at arithmetic, okay? It means that arithmetically, that market is 90% less risky and 90% cheaper than it was at 2011 when everybody was bullish. Everybody was dying to invest in this market when it was 10 times as dear. Nobody wants to get near this market when it's a tenth as risky. And I like to be on the other side of both of those prints.
Absolutely. So you're seeing not a lot of risk in the sector right now, and it might be a good time for people to seize the opportunities.
There's always risk in this sector because 80% of the companies are valueless. They're perpetually overpriced. But the 20%, the remnant, is stupidly cheap. An example would be this morning, Probe Mines, a company you do well, got taken over by a very knowledgeable buyer at a 50% premium to market. And they thought they're going to make money from there. Now, think about the market's opinion relative to Probe and Goldcorp's opinion relative to Probe. Who do you think knew the company better?
Well, a $5 takeover says a lot, I think.
And it's indicative of where we are in the market.
Absolutely. Well, thank you so much for joining us today, Rick. It was a pleasure having you on.
It's always a pleasure. Thank you for intelligent questions. They're a rarity.